The RSI technical indicator doesn't work on a 14-period setting. If you use the overbought and oversold zones, that doesn't work either. How can you really take advantage of this technical indicator the right way? Stay tuned until the end of this video, because I'm going to reveal the RSI settings that actually work. I'm also going to share my 2 best trading strategies that use only the RSI and price action. So, how do we interpret the RSI? As you can see, there are several zones on the RSI, starting with the green oversold zone. That simply means the market has been heavily sold. We'll see more about that later. It doesn't mean you should buy. On the other hand, there's the overbought zone shown in red, and as you might guess, that means prices have gone up a lot, and it's something you should take into account in your trading strategy. The most important zone is the 50% area marked in yellow. Overall, when the market is bullish, the RSI will be above the 50% zone. Once the market turns around and changes trend, right here, you can see on the RSI that the market will drop below the 50% zone and stay below it as long as the market remains bearish. The biggest mistake beginner traders make is thinking that just because the market is approaching or entering the oversold zone, it's a buy signal. This is completely false. Sure, the market is bearish. Sure, the market has dropped a lot. That doesn't mean it's going to go back up just because the RSI is in the 30% zone. Look at what happens next. You got a tiny bounce, but overall the market stays very bearish. Here, you lose money if you buy. Second example, here, as you can see, the market has entered the oversold zone. Is that a buy signal? I don't think so. And look at what happens next. The market just hesitates a bit and then continues its downward trend. So here, by using the strategy of buying when the market enters the 30% RSI zone, you lose twice in a row. Of course, sometimes it will work. I'm not saying otherwise. But now I'm going to show you the best way to use the RSI to get a much higher success rate. But first, let me share with you the settings I personally use. As you can see, the RSI isn't set to 7 periods. It's not set to 14 periods. It's set to 21 periods. Because with 21 periods, the RSI gives far fewer false signals than with 14 periods. I've been able to observe this over the years I've spent in the financial markets. Now I'm going to share with you a very effective first strategy using only the RSI and price action. As you can see on the left, the market is bullish. What we're going to try to spot are divergences between what the chart is telling us and what the RSI is telling us. You can see here that the market is reaching a top. The highs of these candlesticks are slightly bullish or even flat. But on the RSI, as you can see at the bottom, the market is going down. The highs are getting lower and lower. So we have an indicator showing us a price that's going down and a candlestick chart showing us a price that's slightly rising or flat. This is what we call a divergence. And as traders, we can take advantage of this divergence. For example, here, what you should have done is, once you've spotted this bearish divergence, wait for the market to give you confirmation signals of this divergence. The confirmation signals are very simple. We're going to look at price action and the breakouts of price zones. You can see that, in addition to having a chart pattern indicating a trend reversal, we also have the price re-entering this price zone. It was a resistance, then a support after the breakout here. And you can see here, the price breaks down below the support. So it becomes a resistance again. We have a re-entry of the price. You can also see that, on top of that, we have a break below the 50% zone on the RSI. And if you listen to what I said at the beginning of the video, you know that when the market breaks below the 50 zone on the RSI, it means it's going to turn bearish, at least for a while. So you have a trade entry here, and for the target, you're aiming for the previous price zone. The target is never set randomly. You can see that the previous price zone of the market, the order block, is right here. This was the starting point of the bullish move here. And we consider that if the market re-enters this price zone, it's to revisit the previous prices of the order block. So you have a trade with an excellent risk-reward ratio. You can set your stop loss slightly above the zone, and with just a little patience, the market will hit your target. The second strategy is a trend following and momentum strategy. We're looking at the euro-dollar, and we're going to focus on this very interesting market phase. You can see here a huge bullish candle that gives a direct buy signal. But as a responsible and professional trader, you don't buy at the close of this 15-minute candle. You wait for a better entry price. Why not wait for a retest of the price zone? Like what's about to happen here? You can see that the market comes back and bounces precisely on the former resistance, which now becomes a support. Here, the market confirms that the uptrend is taking shape and that this price zone is now a support. The trade here is very straightforward to take with this bullish confirmation candle on the support. And on the RSI, what will also reinforce our bullish scenario is that, as you can see, the market will correct and bounce almost exactly at the 50% zone of the RSI. So, you have the market showing you through price action that an upward move is now to be expected, and you have the RSI confirming this. So you have a convergence of trading signals. The more signals you accumulate in the direction of your scenario, the more confident you can be in your buy. We can also have some fun by placing a Fibonacci from the start of the move up to the top of the first volatile movement here. And you can see that the market is going to bounce right on the 61.8% Fibonacci retracement. That's a huge support level. So you have a lot of signals pointing in the same direction. You can take this buy with peace of mind. Here, you enter at the close of the 15-minute confirmation candle. You set the stop loss just below the confirmation candle in the price zone, which helps protect against a false bullish breakout. It's recommended to have at least a 2-to-1 risk-reward ratio. So, if you're risking $50 on your stop loss, it's to make at least $100 on your first target. Then, with a bit of patience, you see, the market will keep going up. When this high is broken here, you have a new buying point. You can see how powerful it is to use bounces off the 50% zone. You can see how powerful it is to use bounces. It really gives you very precise entry points, really nice confirmations for a trader. Thank you all for your attention, and I'll see you next time.